Welcome, guys. This is a class, well, a recording of a class on risk management, because this isn't live, obviously, but this video will be through risk management, small account, how to take a small account and grow it safely into a bigger account based on learning how to scale into trades and how to trim your profits. A lot of people don't understand when their trade is going their way how to take profit, and that's very crucial. So I'll be teaching you guys exactly how to do that. So going in to the first thing here, every day I always have a specific rule for how many trades I get into in one day. Let's say the first scenario here, first trade I take is normal size, obviously. Now, whether that's a starting normal size position where I don't go in full size, but I get into some starters, that normal size of starters, or a full position. Let's say I get into a full position, it's normal size, right? That's the first trade will always be normal size. So if the first trade is a loss, then the second trade will also be executed at normal size. Why I do that, why I don't go in half size on the second trade, for one very specific reason, right? I'm taking that trade if I like what I'm seeing, only for the fact that I want to recover my loss from my first trade. If I go in half size on the next trade, even if I win that second trade, I'm still red on the day. I'm still losing on the day because of my first trade, right? So it's very specific. Take full size on your second trade if you lose your first trade to recover your loss from your first trade, because then you can be green on the day or break even. Break even is perfect, or green is even more perfect, all right? So that's the first scenario. But let's say the second scenario, right? Let's say our first trade, it's normal size still, and it's a win. If the first trade is a win, if I gain profit, if I'm green on the first trade, the second trade will also be executed, will be executed at half size. I'm not going to go in full size on my second trade if I win my first trade for two reasons. All right, I want to manage my risk for my second trade that I took because I won my first trade. I want to manage that risk because I'm still wanting to get potential profit from the second trade, but I don't want to become red on the day. So if I go in full size on my second trade when I won my first trade, I could go red on the day, or I could go back to break even, which is not good if I won my first trade. So that's why I'm allowing myself to take a second trade. Sometimes I don't even take a second trade if my first trade is pretty big. But if I do take a second trade because I won my first trade, I'm only doing this to maybe get some more potential profit. But even if I lose that second trade, since I'm going half size, I won't be red on the day. Now the third potential thing, where the third potential scenario is unlikely because it doesn't normally happen, but it will, right? It always will. The first trade is a loss and the second trade is a loss. Both normal sizing, obviously, because I lost my first trade, I'm going in full size on my second trade as well. So if both trades are losses, I'm going to stop trading for the day, no matter what, because I need to mitigate my losses and I also need to control my emotion. All right, my emotion is probably very heavy if I lose two trades. It won't be good if I go in another trade. It won't end well. Trust me, it won't end well. There's a reason why I put this as a third scenario, because it has happened, okay? So just stick to your rule. If you lose two trades, don't trade for the day. If I lose one trade and I don't like what I'm seeing that day, I'm not going to trade again. I'll just have one loss too. So just follow your rules. Try to preserve your capital. That is the most important part of trading, is preserving capital for long-term sustainability, which we'll go over in a second. Right here, actually. So the thing is to define your risk. Every time before you enter a trade, so you see a setup that you really like, every time before you enter it, you have to know your maximum risk for any trade, for every trade. Know exactly how much you're willing to risk for that trade. That will allow you to become disciplined. And as a trader, that's very important to be disciplined when trading, and also offer long-term gains or long-term profit. Because you have to understand that day trading is just a short action, right? It's just day trading for the day, for one day. Day trading for maybe 30 minutes, 15 minutes, whatever. Maybe if you're a scalper, day trading for a couple seconds, right? To get long-term gains. All right. Day trading, the only reason, the goal of day trading is to become financially independent through long-term gains, right? So understand that you have to identify some type of risk to your trade every time. You have to know that you might lose. So put your maximum risk at a position where your account won't it'll affect it, but it will barely affect it, right? That's the whole point. You're gonna lose a trade, but if your win rate is high enough and you have proper risk management, then that means that your losses won't matter because your wins will outweigh it if you have proper risk management. And I think 90% of traders have proper risk management, right? But the thing, we'll go over that, what I mean by that in just a second, right? But first, let's go over daily risk here. So if I'm green on the first day, after a successful day, after I win my first day, we're gonna go next day normal position sizing, right? So I always start Monday as my first day. Monday's my first day trading, full size, normal size on Monday, and if I win that day, then I'm going in full size the next day on Tuesday, right? That helps me capitalize on positive momentum from my first day, and I'm confident in myself. That helps me while also still preserving capital. I'm not just gonna go up on my size for Tuesday, right? Just because I won on Monday. That's incredibly stupid. I'm also not gonna go in half size because I'm confident on the day. I want to capitalize on that positive momentum and make even more money, but I also don't want to lose more money, right? So preserve your capital, just keep it the same size if you win the first day. But let's say I'm red on Monday, right? After a bad day, after a loss, well, we're going to take our position size and just half it. All right. So I want to reassess how the market conditions are. If I'm having a bad day on Monday, well, there's probably a reason for that, right? I want to look at the market conditions and understand why I lost that trade, because I rarely have a losing day. So I always want to reassess the market condition and understand why I lost any trade. And I also want to minimize further drawback. I don't want to lose more money. I'm not going to go in full size after a bad day and lose more money, right? I want to go in half size, build up my confidence more. If I win that trade, even though it's half size, I can build up my confidence in understanding that, all right, it was just an off day. Market condition is still fine. I like what I'm seeing. Then I'll go in full size the next day, right? Just that. It's very simple. That's my rule. You don't have to do that. That's just how I play when I trade. And if you're going to take my trades, I think you should play the same way. Keep it safe, right? Now, just define your entries, right? You all have strategies, whether it's the same as mine or not. You have strategies, you have entries, and you have your ideal setups. Mine are usually break and retest, bounce and rejects. Bounces to go long or rejects to go short, and also continuation breaks or momentum breaks, right? Like, let's say you have SPY at price of 550 and it's currently at 550 and there's a major level at 555 or something. I see it break 555 and I'm going on continuation break. So I'm going, as it breaks 555, a key level, and it keeps going. That's a continuation break. I go long once it breaks that level, to take profit from that. That's a continuation break. That's one of my setups, okay? That's what it means, basically, a momentum break. Capitalize on the continuation or the momentum. This is what I want to talk about after I said 90% of traders have proper risk management, all right? No strategy is going to work 100% of the time. Understand that. No strategy is 100% correct. That's not how it works, because trading it's a game of probability, right? With probability comes into that term, you're almost never going to see 100% win rate in trading, right? Only price action, reading the market, and risk management will be the factors that differentiate you between a profitable trader and a trader. And when I mean 90% of traders have proper risk management, I mean that because 90% of traders know how to manage their risk, know how to manage their account size. What they don't know how to manage is this. Excuse me for my incredible spelling, but emotion. They don't know how to manage their emotion. And we're all human. I get it. We're all human. We'll have some days like this where we just can't control our emotions and we're not strong enough, and we'll overtrade, oversize on the trade, stuff like that, right? And for new traders, this is the worst thing, and it's the biggest thing. It's the most common error in a noob trader. a beginner trader, a novice trader. It's emotion. People know how to risk their man. It's very simple to know how to manage your risk on your account based on your total capital of your account. It's extremely hard because we're human to manage your emotion. So to understand how to manage your emotion, I can't teach you that. No one can teach you that. But you, and looking at the market, you have to have the discipline to understand not to overtrade, not to oversize. And that's easier said than done, obviously. But you just have to break through that wall. That's just it. You know, to break through that wall. I can't teach you how to have strong emotions. I can't. I can't teach you to once you lose a trade to get up, turn off your TV or your computer and just get out. I can't teach you that. Only you can tell yourself to stop trading that day. So that's what I mean by 90% of traders. I'll even go 99% of traders know how to have proper risk management. Their emotions just suck. And that also I can say, fortunately, it's a stronger emotion in trading is also gained through experience. You're going to be losing so much at one point that you're going to be like, okay, I gotta hold up now. I gotta get better. And I hope that happens to most of you, all right? But emotion is the most critical error when it comes to a novice trader. Also, it's strategy hopping. A lot of people like to hop between strategies. That's incredibly stupid. All right, you have to stick to one strategy. You're just changing strategies is not going to work because each strategy has a different levels, key levels that they look at. Each strategy has different indicators or whatever that they look at. So each strategy, there's always a loss that you're going to maintain. You're always losing with each strategy. Imagine strategy hopping and losing each strategy. You're just going to lose even more, right? That's what I'm trying to tell you. You're going to lose more if you keep strategy hopping. Stick to one strategy. And how do you stick to one strategy? Well, you first learn the fundamentals. So the basics of charting key levels. Learn how to identify key price levels on the chart. That's the first thing. Learn how to chart supply and demand. See where there's a volatile price movements on the chart. Historical volatile price movements on the chart. Chart those. Chart supply and demand. Learn how to identify where price is likely headed towards, right? Learn how to read price action. Now, I understand a lot of you guys don't know how to actually read price action. A lot of people in our Discord do because we've taught them the right way to read price action. There's a wrong way to read price action and there's a right way. What I mean by that is you have a lot of these traders, these trading gurus or whatever, teaching you the wrong way to teach price action or to read price action because they just think it's based off chart patterns and looking at the charts. That's not it, all right? They're selling you a dream to think it's that simple, but in reality, price action means reading real market data. To know how to read real market data, you have to understand how to read the tape. How to read time and sales data, how to look at order flow, how to read Bookmap, how to read real market data coming in from big hedge funds, big investors, these big guys, these big traders coming in. That is where how the market moves. That's how you read price action, right? So you have all these famous trading gurus teaching you something that's complete bullcrap, but a lot of people still believe it because it seems simple. Trading is never that simple, okay? Don't believe a dream that you're never going to achieve because it's the wrong way to achieve it. Believe in real price action. You know how the market works. You know how stock market works. You know that retail traders aren't moving the market as much as it is. It's the big guys. So looking at chart patterns isn't going to help you. These big guys, they don't look at chart patterns. They look at price. They look at price. And that's real market data coming in through price. And you can see exactly how they're moving the market and what direction. So all of this, you then structure a trading strategy around this. Now, you can go off my strategy. You can go off someone else's strategy. You can even try to find your own strategy by looking at a lot of other people's strategies and just nitpicking, one thing of one person's strategy and another thing of another person's strategy. That's completely fine and making it one. But just all I'm saying is stick to one strategy. Just find out your win rate of that strategy and just stick to it. Even if you have a 20% win rate, which I bet most of you don't. I bet most of you have at least a 50% win rate on your strategy. It's just your emotion and risk management that's clouding your win rate, right? That's making you lose as much, okay? But I bet you have a good strategy and you should stick to it. Stop trying to find other people's strategies and stick to your own. Because like I said, there's no special strategy. There's no better strategy than another one. All right, there's no specific way to read the market. You know, you have time and sales data, you have Bookmap, you have looking at the chart, looking at key price areas. There's no specific way to read it. But there's obviously, I would say there's better ways in my opinion, like actually reading real market data, but that's still very limited, right? Because if learning how to read market data, real market data, like the tape and order flow was so good, I would have a 100% win rate, which I don't. I have a higher win rate than most people because of that, because it gives me an advantage, an edge, but it's not enough. All right. So your strategy is not the holy grail. And what I mean by that is when I said fundamentals, like learning key areas, learning how to read the tape, order flow, all of that, it will give you an advantage in trading. It will give you an edge, but it's not enough. What you're missing, I can't help you because it's only gained through experience in the market. That's what I stress a lot, is that to become a great trader, you need experience in the market. It's not a get rich quick scheme. So understand that there is something you're missing. If you're a new trader to this and you have been trading for a long time, you're missing something. Don't worry, you'll gain it through experience. Don't quit and you'll gain that. Then you'll have it all. You'll have the puzzles and you'll fit them together and you'll see exactly what I mean. So I really do hope you look at this video and you remember this, because when years go by and you actually gain that experience and you actually find out what you're missing, I want you to come to me and say, you're right, this is it. All right. So understand that there's something you're missing, but you'll gain it through experience in the market. And for example, what I mean by that, what I mean is like, what am I missing? Let's say, for example, there's a continuation break on SPY and I don't take that trade. And someone asked me, how did you know that when that action and that continuation break, that momentum break was not probable to continue? How did you know that? Well, the longer you trade, the better reads you will get. Maybe I didn't like what I was seeing in the tape. Maybe I didn't like something that was happening in the charts in the market. Maybe I saw some news before then that I didn't like. Something like that, right? The longer you trade, the better you will get at reading the market. Now, let's go into scaling. How to scale. Now, whether you have a small account or a big account, it's always important to know how to scale into trades, right? This is how I trade. A lot of people just go in full size or normal size off the bat. I do that too, especially during intraday trades. And what I mean by intraday trades is I mean by like not market open, right? I mean like an hour after market open. That's what I consider an intraday trade, where the market is less volume, right? It's going in more of in a range. It's not as volatile. IV is lower. I'll go in full size right off the bat sometimes off that, just because I understand that price won't move as much, so it's not going to be as intense as getting in a trade right off the open, let's say, right? But let's go into scaling. Scaling, what it means is partially buying into positions at key levels with the goal of getting a great dollar cost average for your trade. So understand that you might have these levels, right, where you want to expect a bounce or reject, a break and retest, something like a continuation break, whatever. But most importantly, like a bounce and reject or a break and retest. You scale into that trade to get early exposure, but you have to like the price action first, right? Usually what I mean by that is reading the tape. I want to see the time and sales data. I want to see if that price action is looking good for me to actually get early exposure into that trade. And that means if I'm expecting a bounce to go in long, I want to see a lot of buyers getting into position before that level where I'm expecting a bounce. And that's when I'll get in some early exposure for that trade, right? So it basically allows you to hold on to the trade longer and avoid getting stopped out easily. And I like that because that trade could always go your way before you expect that original bounce, and which is why I like to get some early exposure into that trade, because it will happen as a trader. I've learned how to do this because of my experience in the market. All right. I never really used to do scaling when I was starting out as trading, but I figured it out how to do it once I got more of a skin into the market, right? Once I got more experience in the market, I learned that this was a great way to do it because of my experience in the market. I saw that my levels weren't always getting hit perfectly, maybe just a little before. So that's why I really like scaling into trades. Now, the rules for scaling, there's always rules for anything, right? There's rules for your entries, for your setups, and for scaling, and for trimming profits or taking profits. There's always rules. So my rules for scaling, Well, you should only scale into trades if your intention before entering the trade was to scale. If you didn't intend to scale into the trade or to add into more of your size into trades, then you shouldn't scale into the trade, right? If your intent to get into that trade was to go full size of the trade, then you go full size of the trade. So only scale into trades if you are wanting to scale into the trade before you even enter the trade. Now, let's look at your position size and your risk. When you're scaling, that should still not change. It's just how you put your money into scaling is what changes, right? But your total position size, your total risk should not change. So what I mean by that is, let's say your account size is $100,000, right? If it's $100,000 and your normal position size is $3,000, then you should not put more than $3,000 into that trade, all right? Don't put $4,000, don't put $5,000. You're scaling into that trade to hopefully get to your full size of $3,000. But if it doesn't happen, it doesn't happen. Just don't put any more than your full size and your full risk, okay? Now, more of the rules is do not try scaling into trades on continuation breaks, especially at market open. For break and retests, let's say there's a level here, break and retest, and then go long. It's different, for bounces or rejects, it's different. There's more of a clear risk defined off these. But with continuation breaks, which is basically this, price is going up, key level, and it breaks, there's not a lot of well-known risk going off on continuation breaks. There's not, especially on market open, because on market open, the trend for the day isn't set, right? So how you're going to want to go about this is don't scale into those trades, right? If you see a continuation break off the open, usually I'm going to always go in full normal size, full size, normal size off the bat and put my stop loss below that level or below the candle that broke that level for a continuation break. I'll always put my stop loss at a key level of a candle on the continuation break, just because I can't scale into that trade because the trend for the day is not yet set. IV is very high. It's very volatile. I don't know where my support is on that continuation break. I don't know where it is. That's why continuation breaks are for experienced traders, and break and retest, bounce and rejects are more for novice traders to use because it's more friendly than continuation breaks or momentum breaks. So I'm never going to go in full scale. I'm never going to scale into trades. Never going to get into starters on momentum breaks. Okay. Now, do not scale into trades against your primary trend. So I'm looking at the overall trend for that. Let's say we have, let me delete these things first. Let's say we have a long, a high time frame, like 4-hour daily of an uptrend. I don't want to go against the primary trend, right? I'm not going to scale into trades. Sorry, I do trade against primary trend, but I don't want to scale into trades against the primary trends. All right, I don't want to add against the trend. I always go in full size at a key level only if it hits against the trends, right? And what I mean by that is, let's say there's a key level right here. If I'm adding to go in long, I can add to go in long here, right? Because it's with the trend. And I can add here at this level. And then if it breaks that level and comes down here, I'll add here fully and for it to go long, right? And I can do that because it's with the trend. But let's say let's say we're going on, let me delete this. Let's say we're going up here, right? There is let me delete this more actually, it's too high up there. We're going up here, and there's a key level right here. And I'm trying to go against the trend, right? I'm not going to add right here, and then it breaks that trend and add right here. It's against the trend. There's no reason for that. I'm just I'm increasing my risks for stupid reasons because it's against the trend. Always want to follow the trend if you're trying to scale into it. And because the trend on the long, higher time frames, like the 4 hour, the daily, the weekly, they're important because they usually respect that trend. Unless something extreme happens, they usually like to respect those trends. And you want to look at it into the shorter time frames, understanding that if I'm ever going to take a trade against the trend, I'm going to go in normal full size if it ever hits a key level. So this is a key level. This wasn't a key level. So I'm going to wait for it to actually hit this key level for me to go against the trend. Because if it doesn't, I'm just adding into a losing trade that is predestined to lose because it's against the trend. If you're going against the trend, your trade is always predestined to lose. Why are you adding on a trade that's predestined to lose? All right. So don't do that. And also, you want to scale in at key spots, not random areas on the chart. And again, what I mean by that is we have SPY at, there's a key level at 550, key zone at 550, 549. Let's say it's going here, and this is the key level. 549, let's say it's this level, 549 and 550 and 549. This is a key zone, right? I'm not going to add at random spots. I'm not going to add at, because I think it's really close. I'm going to add at 551, 552. I'm going to wait for it to hit my level of 550, my zone, to add, and then if it breaks this level, or just say it just bounces and goes, that's perfect. I got some early exposure to the trade for that reason, but at a key level. But if it breaks and just bounces off my 549, perfect, right? So I'm not going to just add at random areas. That's stupid. Add at key levels. You have key zones. Usually those zones are $1 range or more range. That's what I mean by key levels. Inside that zone, key levels at that zone, right? I'm going to add there. Delete all this. Now, this is one of the ways I scale into 2 by 2. So it should be very simple for you guys. I just divide my normal size by 2. So let's say your normal size is 1,000, and I'm using $1,000 for a normal total size, right? If I'm scaling into a trade, I'm going to use $500 twice. So if I'm getting into a trade here, and I plan to add here, it breaks down for a bounce for longs, I'm putting $500 at this level. Hopefully you guys understand this is $500. And I'm also putting, let's say it breaks this level and it goes here, I'm putting $500 in this level too. And that's my full size, $1,000. It bounces up and I take profit, right? So just divide it by 2 your full size. That's how you scale basically. You just half it. If you're planning to add only once, you just half it by 2. So put $500 in your first time and $500 in your final add, right? That is how you basically scale into trades for if you're only adding in once. And your initial entry would be around bounce and reject levels, and the second add would be after the initial bounce, right? So like I said, if SPY is going to bounce somewhere between 500 and 505, you can get a start position at 505 to go along and catch the wave early. But SPY breaks 505 and bounces between 504, bounces at 504.2. My bad. I meant to put a 4 here. Let's change this into a 4. There we go. Now you guys know. 504 to 505. Sorry, that was such a wide range. 504 to 505. There's expected to bounce at this level. But SPY breaks 505 and bounces at 504.2. I will add to my position if you want, and then define risk much simpler. Now it's much simpler. Now I can define my stop below 504 if it does break 504. Perfect. See, that's what I mean when you add into your final position, you can get a better risk with that. That's why you add. Now, if the 504.2 level does not hold, that means one of two things are possible. There's selling momentum is either very strong. So if there's too many sellers going in the tape, going in the chart, the stock is intended to drop even more, right? So it was most likely possible to break 504 even. So best you stop out at the break below 504.2, you can take a smaller loss if the momentum is very strong at the break of 504.2. But let's say the momentum is slow and the stock is holding well around that level, right? You can then give your trade some more breathing room, okay? So you're going to set up your stop at your original level of the break of 504. So even if you do lose, that was still your original stop. With this one, you just have to look at it. You kind of have to get a feel of the market, which is where experience comes in, right? If you see too many sellers on the tape, on order flow, or you just look at the chart, yeah, there's a big red candle breaking 504.2, then if you want to, best you stop out and take a smaller loss, right? But if you see the momentum is slow, kind of contradictory on the tape, you can see that the stock is holding well. Still a strong level. Then you can give your trade some more breathing room and set your initial stop. Still keep your initial stop at 504 or the break of 504, right? So that's basically what it means. And if your stock is holding well and it holds above your stop loss and it successfully reclaims your previous ad level of 504.2, you can even add in another time if you were trying to scale in 3 times, right? So if you were trying to add, which is what sometimes I do, I usually tell the people on my Discord when I'm taking a trade how many times I'm going to scale in. If I have 1 ad or 2 ads. So if I'm getting into this trade 3 times, that means I'm adding 2 times. So if you were going to scale in 3 to 3, this is when you would do it, right? So if your stock is holding above your stop loss and it successfully reclaims your previous ad level of 504.2, you can add in even another time if you were scaling in 3 by 3 to get your full position into it. And basically what that means is 2 by 2, right? You have 2 by 2, you putting in 500 twice. Well, for 3 by 3, I'm going to do it right here. Very weird. Putting in 250. Oh, sorry. That one. $350. My bad. I had to do the math there. 350 3 times. All right. Pretty simple here. About 353 times. Not super close. Can't really do 1,000, divided by 3 and get the perfect answer. I'm actually gonna check how much that is. 333.3. All right. So 333. Let's just do that. Whatever. 333. 3 times. Okay. That is how much you're going to. That's how much you're going to put in for each ad, right? Your initial starter position is going to be $333. Then if it breaks that level and goes into your other and bounces off your other key level below, you add another $330. And then if it breaks that level but reclaims it, and you can see that there's more momentum in that trade, you can add another time to get into an even bigger, or your full position size, right? That's if you were scaling 3 by 3, or that's if you were getting that trade 3 times. Now, in an opening trade, you may not get the opportunity to scale in, but whatever you do, don't use your entire size from the get-go. And what I mean by that is if you're planning to scale into the trade, right? If your plan is to scale into the trade, you enter starter position, you might not get the opportunity. Like I said, you might not get the opportunity to scale in. That's the whole point of it, though. You're getting some early exposure to in case the trade goes your way, actually goes your way. You're getting some early exposure for that, but it might not work for you to get scale in for you to get into your full position. That's what I mean by that. So that's why you're getting early exposure, because if it does go your way before you even get to add, you're not gonna make that much money, but at least you caught the trade, right? That's what I mean. But if it does go your way, don't use your entire size from the get-go, right? So if you see that the first ad you added at like right here was working, don't go in full size here just because you think, oh, it's gonna even go me more. Just don't. Right? Stick to your rule of scaling a trade. If you were planning to scale into the trade before the trade and you did your scale, don't break it. All right? Just because you think you're gonna make more money, it could easily just reverse back here and fuck you up. Okay? So just don't do that. Stick to your rules, guys. Expect the best outcome, but always be prepared for the worst. Every time I go into a trade, I'm confident in that trade. I expect to win every single time. But I'm always prepared to lose. I'm always prepared to lose because I always have to have a stop loss, a manual stop loss in your mind, a stop loss in your mind, or you can have an automatic stop loss. But I'm always prepared to lose, which is why I always have a stop loss, right? Because you always have to be prepared for the worst, okay? Respect your stop loss rule. If it breaks a level that you're supposed to stop out and it closes out, or it breaks whatever rule you have, stop out of the trade, all right? It's not going your way. One trade is not going to make or break your entire account if you risk it properly. If you just full port, it will. But if you risk it properly, one trade is not going to define you. And I like to think of this of the Batman movie, right? I'm pretty sure it's Batman Begins, right? Or the good Batman, Christian Bale, when he said, he was like, it's not who I am. It's not who I am underneath that defines me, or it's not who I am underneath. It's what I do that defines me. As a trader, it's not your rules that define you. It's what you do that defines you, because you can easily break your rules and just become an ignorant trader, and that's who you are. That's what kind of trader you are. So it's not what you it's not who you are as a trader. It's not what your rule is as a trader. It's what you do as a trader. If you follow your rules, are you disciplined enough to follow your rules? Then that is who you are as a trader. You're a profitable trader. You're a disciplined trader. But just because you have rules to follow and you don't follow them, that's what I mean. If you have rules but you don't follow them, there's no point, right? So it's not who you are, it's what you do as a trader that defines you, okay? Now, trimming contracts, all right? We're going to go to TradingView here for a second. We're going to look at the charts, and I'm going to show you exactly how to trim contracts, how to take profits when your trade is going your way, all right? All right, guys, so here's TradingView. Let me see if you guys can see it. Yeah, you guys can see it here. So this is a trade I took off Tesla, right about here. Now, we're going against a trend, and like I said in previous slides, if we're going against a trend, I never try to scale in. I'm always going in normal size against a trend, right? Let's say I took a trade right here, right? And I waited for the reject off this level. And now the tricky thing about this thing, which is what I want to show you first, the tricky thing about looking into to take trims or take profits, and what I mean by taking trims, I mean, let's say I have 10 contracts in a trade. At a certain level, I'm taking 5 contracts out to secure profits. Then I'm keeping those other 5 contracts to take more profits at another level, right? So that's what I mean, right? And this trade, I'm not certain exactly how many contracts I was in at full size. I don't remember what price the option contracts were at, but let's say theoretically, I know I did 2 full size. I know I did 2 trims. So I took 1 trim and I took full out at another level. So let's say I had 10 contracts, right? For the heck of it. I had 10 contracts going into the short on Tesla. Since there's no strong level here besides besides the highs of yesterday's market, I have to be sustainable enough to understand how I'm going to take this trade, right? Do I wait for it to go all the way to this level? Or do I play more conservative and take it at another level between here, right? So that's what I did. I took a first trim at about right here. And that was about 20%, I would say. And I took this trim. I took, let's say theoretically, I took 5 contracts out. I took 5 contracts out, and then I waited for price to go lower and hit this level to take my full position out, right? because this was the strongest level there was, and I wanted to take most of it out at this level if I remember so, but I didn't like the action that was going around at this time, so I took it all out at this level. And that's what I mean, right? You want to take profit out at at key areas. Sorry, you want to take profit out at key areas of the chart if you can find one, right? If not, it's just up to you on how you do it. But with me, I look at, if I don't see any considerable level off the charts, I like to take profit at 20%. I like that. It's simple, mostly because my stop loss is 20% usually, right? Sometimes it could be less than that if I fully add into a trade. But since I didn't add in this trade, my stop loss was going to be around, I'd say 10 to 20%, right? If I remember correctly. So 10 to 20% was my stop loss around this area. I don't remember the exact percentage, but it was around that. And I wanted to at least do a 1-to-1 reward ratio on that, since there was no considerate levels. So I took a 20% trim at around right here. Then I waited for price to go back and for price to continue and break and go here at yesterday's market high for full profit. And when I did that, right, if I took a bounce, a reject off that level, and my stop was at the highs right here, I would have moved my stop to exactly where that other one was, right here, to put it at break even. That way it was a risk-free trade. I took 20% off 5 contracts off that. If it does pull back and go back to my original entry, break even, I'm good with that, right? Risk-free trade. So that's why I like trimming profits at a significant level, or 20%, and then moving my stop to break even, so I don't have to worry about that trade anymore, right? It could go my way, perfect. It couldn't go my way, I'll just get out of break even on those runners. Amazing, right? Now, I want to do this one first because I want to show you that sometimes it gets iffy, right? Sometimes there's not any specific level unless it's very far away. And you can either hold to that level, or you can be conservative like I am usually and take trims along the way. And I like to do that if I don't see a considerate level here, right? Let's say I took longs here. If I don't see a considerate level like I do here, clearly I can see like this level right here is a nice level to take trims, to wait to go to the highs. If I don't see that when I'm during this trade, then I'll take it at 20%, right? I'll take it at a percentage level. But usually if there is a level that I can see, like let's go here, right? If I took a bounce off here and I see there's a considerate level like around here where price could reverse back, I'm gonna take a trim there, and then I'm gonna wait until it passes these highs right here to take full profit. Perfect, right? Let's go even more here. Let's go here, right? Let's delete these. Second. It's just something like cluttered. Let's say we're taking a short off this level, right? Take a short off this level. I see there's a level right here where price could theoretically reverse back into. So I want to take a trim right there, right? And then I want to wait until it goes to the lows here of pre-market to take more profit out, right? Basically that. It's very simple how to trim profits, but a lot of people don't know how to trim your contracts. And at that point, it's just what your risk to reward ratio is, With me, my win rate is high enough where I can do a 1-to-1 risk to reward, right? And with that, usually my stop loss is around 10 to 20%. And with 10 to 20% stop loss, I want my first trim to be good for break-even trade, right? So if, let's say in that trade, I analyze my stop loss to be 15%, I'm going to take a trim at 15% and move my stop loss to break even on the other contracts, so it's a risk-free trade. And doing that, so I feel like it's the best way to trade options. Now, you don't have to do that with other things. I just feel like options, it's really good to, trim some contracts out, move your stop loss to break even when you got into the entry, and then let the trade go risk free, and it can either go your way or you can just hit break even on the runners, right? And how much contracts you should trim going into that is entirely dependent on what type of trader you are. So you can either trim a couple contracts off that and then hold more for a longer gain, or you can be conservative and like trim half or trim 75% and hold just a couple for a little bit more gain, right? Just understand that if you do the latter, right, if you trim 50% or more on your first trim, you can't get more, you can't get as much of a gain as you could if you didn't trim, if you trimmed less, right? So if you want to get those profits, those those percentages of a 50% profit on that trade, or even more like 100%, gotta understand that you can't trim as much on that. You can't like just, let's say you have 10 contracts, you can't trim 5 contracts off the first trim and then expect to get 50% or 100% even. It's not how it works. But let's say you have 10 contracts and you trim 1, 2, right? Easier way for you to get more contracts off to get into 50% or 100%, right? It's easier because you have more contracts. You have enough size in going to the trade, right? But it's all about the amount of size you have. I stress size importantly for that reason. It's all about the size that you have. Each trader has different size, but if you have, let's say 10 contracts and you want to get those 100% trades, you got to learn to hold on to your contracts a little bit more. But if you're very conservative and you don't really want those kind of trades, you'll take 20%, you'll take 30, you'll take 40. You don't have to do that then. You can trim a lot at your first trim. You can take as many contracts as you want on your first trim and then hold it until 20%, 30%, whatever, right? It's just what kind of gains you want, right? And when I'm conservative, I do that. When I'm feeling the trade, I'll trim a little bit and I'll take it to 50% or 100%. But it's just what type of trader you are, right? Are you very conservative, or are you willing to risk? Are you willing to put more contracts into longer term gains, basically? Okay, but that's how you trim. That's how you trim your profits, man. It's very simple. Just try to find key levels to trim profits at. Let's say you have VWAP, right? VWAP is a great level. I would like to trim too. I'm just gonna go on the indicators here and search VWAP. EMA is also another good one to trim. VWAP. Nice. VWAP right here. This is the upper and lower band of VWAP. The blue one is actual VWAP. You know, let's say you get into this trade right here and you want to trim here too, which is usually aligned pretty well with the level here. So you want to trim here. You know, basically that. And if you want to then see another key level at the pre-market low to take all your profits or a little bit of your profits and just wait for more, perfectly fine. For me, I don't really see much here except for this level right here at market open, where you could take all your profits at. It did hit that, which is perfectly fine, but it's all about trailing your stops too, right? So let's say I got here, I took trims here, I moved my stop to break even, right? Let's say I got in this entry, my stop was above here, and I moved my stop to break even. And then I took more trims off here. I'm gonna move my stop to here then, where I took that trim, right? So I secure even more profits, right? So it hit that, but it did go and hit that stop. So that's what I mean, right? That's kind of what I mean. You could take what I would have done is I would have taken full profits here, right here, because I want to make sure that my trade is good enough to the point where I could take a little bit and just move my stop to where I trimmed before, and it'll hit. But if in this moment, if I was taking this trade, that's just me, it's preference, right? I would have taken full profits here. Or max, I probably would have held. Because this is a big move, by the way, guys. This is more than a $5 move. So I would have taken most profits here. Maybe I would have left one contract here, maybe, to go to the right here, which is this pre-market. Can you see here? This pre-market. This market open low. And it's up to you. Preference of a trader, right? That was my preference. If you're different, and I have a lot of contracts to trade, but if you don't have as much, then don't be greedy. Take what you can, right? All right, moving on to the PowerPoint. Okay, now we're at the number of contracts. So like you saw before here, a lot of people are asking this and they want to know how much option contracts should you get in depending on your account. And well, there's two things here. Sorry, how many option contracts, how many future contracts should you get in, right? It depends on how much your account is, right? What's your total capital of your account? How much money do you have in your account? And how much each option contract is worth. So when it comes with features, it's much simpler, but with options, these contracts are worth different money. They're different, a different amount, right? You could be trading SPY, it could be, $100. You can trade in Tesla, it could be $300, something like that. So you never know exactly how much each option contract is worth, but you have a simple, I guess, equation you can do to find it out, right? Let's say your total account is $100,000. Let's say you want to risk 2% of that $100,000 for each trade. Just remove that. Now, 2% risk, that's $2,000, right? For a $2,000 that you're risking for each trade, well, you're going to want to see exactly how much each contract is worth. So let's say you're trading a contract that's worth $500. Well, if you think you want to go in 2% risk off your $100,000 account, then you're going to do $500 times 4. So you're going to go for $2,000, that's 4 contracts, right? So let's say there's a SPY contract that's worth $500, whatever. If you want to use your total 2% risk, you just buy 4 contracts with that, right? So it entirely depends on your total account and how much each option contract is worth. So just do the math, right? If you have a $100,000 account and you want to risk 1% or 2% or even less, which is perfectly fine. Honestly, as a new trader, I think you should either do 1% or less. But if you want to do 2%, that's still fine. But yeah, just find out how much your total account is. See if you want to risk 1%, 2%, or even less. See how much the contract is worth. Figure it out and get as many contracts for that. Now, one thing I will say is, as a trader, when it comes to options, you're always going to want to get more contracts than one. And I say this because I probably told people this like before, saying if you want to get into one option contract, it's fine. And in reality, I don't think it is. In my full opinion, I'm being totally honestly here, I don't think it is. So whether that means you should just go into and choose a cheaper contract, cheaper strike price with a cheaper option contract price, do that so you can get more contracts. I feel like you should have at least 2 to 3 or more than that. And if that means choosing cheaper contracts, then do so, right? If I say I'm getting into this contract that's worth $200 for each contract, right? And you want to choose a cheaper contract because you can only get one contract, then do that, right? If that's how it has to be, do it, because I think you should get more than one contract to scale in and trim, right? To trim contracts, like I showed you previously how to trim your profits, right? So I think you should get more than one contract, and if that means choosing cheaper contracts, do so, because at that point you're able to assess your risk better by scaling in. If I'm scaling in, or if you're trading on your own and you want to scale in, then you can do that effectively. Or trimming contracts, you can trim one contract at a certain percentage, certain level, and then keep that other contract as a runner to get even more profit from it. That too, but that's kind of what my opinion is. I know people that only trade one contract, and that's fine. I just don't think it's worth it. I really don't. I think you should have more contracts, and you can just choose cheaper contracts to do that. So, but yeah, that is everything in this video that I'm going over. And I don't know if I answered all your questions. If you do have any more questions when it comes to risk management, or small accounts, or scaling and trimming profits, feel free to let me know. Either in the Discord, if you're in there, or in the comments. Just let me know, and I'll do my best to answer. All right. But I'll see you guys.